Welcome to the Capital podcast, where we dive into the dynamic world of private capital markets. Whether you're new to private market investing or a seasoned professional, this podcast unpacks the latest trends, insights, and opportunities shaping the industry. Featuring expert guests and deep discussions, Caplander is your go-to resource for staying informed and inspired. Hi, Jody.
Hi, Morgan.
So obviously, we work in compensation. So end of the year, what always comes up for us in particular are salary increases and bonuses and then hiring for 2026. And we run a separate survey that focuses on those topics. We ran our digest, which are monthly newsletters, right before the holidays, kind of in the nick of time. And we're going to go through what some of the data told us. So to start with investment firms, and we'll start with the hiring piece, was that 64% of investment firms who were surveyed reported that they were hiring for 2026, and 97% of them said they were making less than 10 hires.
Yeah, I think that's right. They're going to make key hires and be very strategic about it. But they're clear, just like we are, that they have certain focus areas that need to be addressed, whatever those may be.
Right.
My guess is those areas are more as it relates to portfolio services and services that support the investors. And I highly doubt most of those are at the senior level of the investment team.
I think it's also on the investor relations side,
Yeah,
especially
I agree.
as right. I think that we've seen the compensation grow for those roles over the last 5 years because they've been increasingly important in terms of making sure that the LPs are happy.
Yeah.
So that's one piece. Okay, second piece of investment firms were salary increases. So salary increases are really powerful tools that can be used to award performance, balance cost of living, retain employees. And the biggest piece, as we've talked about this before, is how much of a percentage of a salary increase to give somebody also depends on what the base salary is.
Right. It's better to look at it as a percentage of base pay versus just an actual number.
Right. So, really, where our data showed was that we have 6 levels of investment professionals, which runs from a managing general partner to an associate. And as you go down the food chain from a managing general partner to the associate, the percentage of who received a salary increase increased. So, the more junior a person was, the more likely they were to have a salary increase.
Because they are less on the carried interest mode, and so they're more cash driven.
Right. So 81% of senior associates received a salary increase. 79% of associates received a salary increase versus 39% of managing general partners received a salary increase.
Right.
So the ranges, which was everyone's like, okay, that's great. People receive salary increases, but what are
What
the
they get.
actual what are the
Show me.
numbers?
Yeah.
Right. Show me the money. The increases range from 4% at the median for senior associates up to 10% at the 75th percentile. Associates were also hovering around the 4% the median, but their 75th percentile was 6.5%. And then director principals had higher at the median at 5% and then 10% at the 75th percentile.
I think that's right. We have consistently seen year over year that it's around 4 to 5% and that the higher numbers are between, let's call it 7 to 10.
Yeah. And the number one factor, which I think was really interesting for all of the investment professional positions, was cost of living increase.
I think that's the first time since we've been running this that that's been the case.
Yes, across the board, unanimously, and even on the private company side, which we'll get to in a minute, it was the same thing for the entire global private capital market.
Right, but listen, we've been doing this a long time for private companies, but to many of the investors' credit, they asked, "Okay, we don't want this to be a guessing game and something behind a brick wall that we can't see." And I think it's really great that we have enough data to be able to track all of this, and that we have the trends, and that it's becoming more in tune with what's going on in the market. There's like a certain
Yeah,
practicality about it because it's really a lane of a career.
yeah. I mean, I have to say, I do my own year in review budget to see like what
Thought I do
happened, and
your own year-end. I thought I do your year-end review. Oh, you
you
mean
do
at
my.
home?
I mean, at home, like in my personal life, but looking
Got it.
at what groceries cost, like 2023 versus
Right.
2025. It's higher, and it's not like you're getting anything different, like, the yogurt is the yogurt, and milk is
My
milk and all
homeowners
those
went up,
things.
and I was actually out with a friend last night who lives in the same complex that I do here in Miami, and we were talking about this because
Right.
I kinda want my homeowners to go up because I don't wanna be in a place where they haven't been keeping up like you expected.
I mean, for
Anyways, keep
every
going.
person of
Tell me.
you who likes it, there's probably somebody who's like, "I don't care
You
about
gotta
any adjustments
you
being done. I just mow the grass
gotta
and
pay
that's it. We
more to
don't
get
care about."
more.
Yeah. All right. So the last piece of this were the bonuses, which were for investment professionals, and it was for 2025. And the biggest thing that we saw when looking year over year to for 2024 and for 2023 was that less people got bonuses this year compared to previous years.
I mean, we know the markets have not had a lot of returns, so that's sort of a rounding error that we knew was gonna happen in a negative. They swipe left.
Yeah, they all swiped left hard. On the private company side, there's really been so many articles we've read, and we talked on our team call today about this with OpenAI's pay packages and looking at them as a percentage of revenue. The private
Yeah.
company side, especially from our year-end survey, really showed that the cost of living, which we touched on for investment firms, was the most popular reason as to why people received a salary adjustment. What I did think was interesting was that one of the reasons that we track is salary adjustment or correction, and that went down. So, what it tells us is that companies are getting the compensation right in the beginning, that they don't have to fix it when they get to the end of the year to retain somebody.
That the pr it's ta I think it all ties together. It's taking so long for companies to raise capital, and the also on the employee side, they're very, knowledgeable and educated in terms of what compensations should be, and so those mistakes where VCs are throwing money at companies so fast, they don't have time to get it right, is not the current state of affairs, so people are definitely spending time on making sure that's all the consulting that we're doing, that the mix between cash and equity is right, and that although we occasionally still see that the CEOs, don't put themselves first, but in general,
Yeah.
the teams are looking pretty tight.
Yeah. The difference between the investment firm side and private company was that the ranges were much smaller for what the salary increase percentages were. And it was true across from CEOs down to staff level employees. The highest percentile was at the 75th for a CEO, which was at 5%. And
Yeah.
it was the same thing for the staff level employees. There were just not those
Track.
wider ranges. Right.
Yeah.
Exactly. And then those numbers also did stay steady year over year. The hiring piece of it
Why
for
is that
private
steady?
companies,
It
it all
stayed steady at
they
the average is 4 to 5%.
correct. And then the hiring piece of it is that 83% of private companies are planning to hire in 2026, and the majority of those are only planning on making between 1 to 10 hires. So, really similar to the investment firm piece, and what we've talked about this before, that companies are doing more with less people, hiring people who are willing to do multiple roles, longer hours, etcetera.
Very capable.
Right. But the last part that's new, which actually really leads us into our guest today, is that we did add new questions on secondary transactions. And what was surprising was that we 92% of the respondents that they were not involved in any secondary market transactions, but the 8% who said that they had been said that it was individual direct transfers on a case by case basis to meet individual liquidity needs for that
Right, they needed the
person.
money. Yeah.
Right.
They were who
That's
knows
when
how
they
to
needed the
pay,
money.
wanted to buy a house, you don't know.
Right. Which is part of, I think, where, it does really go full circle is that our guest today is David Spreng, who founded Runway Growth Capital in 2015 as the chairman of the firm's investment committee. He is a seasoned and respected Silicon Valley based investment executive with 30 years of experience as a venture capitalist and growth debt leader. So in 2010, he transitioned from venture capital to growth lending. And he's been committed to the entrepreneurial ecosystem. Hi, David.
Hello, good to see you.
You've been in the venture ecosystem for decades, and you have a little bit of a different angle on it because you're sort of venture debt financing versus true venture. But right now, I think that's sort of become very fashionable because the markets have been tricky. So, what are you seeing?
Yeah, you're absolutely right. I started out my career in venture equity and did that for 25 years and moved over to become a growth lender. and I would say venture debt is a subset of growth lending. But started doing that in 2010 because I saw a big move from growth companies using equity only to growth companies using a combination of equity and debt. And that has certainly proven to be true. And I don't know what inning we're in, but I'd say it's mid innings of this evolution. And the time right now is particularly attractive for doing what we do because of a paucity of exits, very few IPOs, even though there's getting to be a few more. Corporate
Right.
M&A is okay, but not great. And and companies still need capital, and equity investors are reluctant to continue to invest a lot of times, and so the trend is for the best companies to use debt instead of equity.
Can you explain for somebody who is newer to private market investing in general, some of the nuances, like pull kind of do a
Or to if
360.
I was a company looking to raise capital
Right.
and I had to look at the differences between venture and debt, what are the upsides? How do you explain what the debt is versus the traditional venture funding?
Sure. Let's just start at the most basic. So, venture equity or venture capital, same thing, is when a private fund buys shares in your company. So they're coming in, they're making an investment, and of course that requires a valuation. That if we're going to invest $10 million, what percentage of the company do we get? So if the pre-money value is 90 million and you're buying 10, then the post-money is 100, and whatever the share price, it's just math. But there's dilution. You've given up a chunk of your business to an
Right.
equity investor, and they will participate in all of the upside from there. In fact, they're more protected because they get preferred stock, and you, as the founder, owner, or management, probably have common stock. So that's venture equity. Venture
Right. By
debt.
the way, that's where we come into this, right? Because as there's a financing, oftentimes, we have clients right now that have just raised that venture money. And as they said, the VCs took their more than their pound of flesh. And so because you know that the venture money is preferred, and so if there's a liquidation or there's an exit, that they get what their money back off the top with some return on it, some multiple. And so you've got to be really careful about how you divide the equity for founders and the rest of the team apart from what the investors have taken.
Yes, yeah, and your compensation data, I think, is extremely valuable in helping management teams and boards come up with the right structure in terms of base bonus, equity, vesting, all of the kind of things that are associated with compensation for startup executives. But the one thing that's almost always true is their last money out. Now, the
Explain
difference
that.
now let's shift over to
Yeah, shift over.
venture debt. Venture debt is a loan, not an equity investment, and like a mortgage, you don't give up a percentage of your house, you just have to pay it back. And so, for the most part, you can think of venture debt as being non-dilutive or minimally dilutive. Often there's a little sliver of warrants that goes along with the loan, but generally speaking, it's kind of non-dilutive. So the biggest appeal of venture debt versus venture equity is the fact that it's cheaper from a dilution point of view.
Why
It's
doesn't
al-
everyone just do that? Why doesn't everyone just get venture debt?
well, I don't think it's appropriate for really early stage companies, and where Runway focuses and where I have, when I moved to the debt side of the world, I really wanted to focus only on the largest, latest stage, least risky companies where we could write big checks. And
Right.
so so our average company does well over 100 million in revenues. It's more than 15
Definitely
years
not
old.
life science companies, that's for sure.
Yeah, I mean, so the life science companies tend to create enterprise value before they create revenues.
Right.
So that would skew that number lower. And we've done quite a bit of life science and healthcare.
Yeah.
So
Right.
it just shows you the how big some of the other companies are, and the important statistic that I just mentioned is they're more than 15 years old. And the third stat and the last stat is that they've raised over 150 million of equity. So I don't think
Got
you
it.
would call our portfolio company startups anymore. And so we've been successful in executing on our strategy of focusing on the largest, latest stage, least risky, closest to cash flow positive.
And what do you consider, I'm curious, I've not heard this before. What do you consider enterprise value to be? What's your definition?
The market cap of the company, so share price, times the number of shares, and add debt to that. So basically, it's what the company would be sold for if it
Right.
were sold in an M&A transaction. And for us, that's the appropriate enterprise value, because one of our most important statistics in managing risk is loan to value.
Right.
And we the a lot of lenders got sucked into using inflated enterprise values when the market was really frothy, and we never use the value as established by the venture capitalists as the true enterprise value. The
Yeah,
what
that's
we
interesting. We don't either. When we do compensation, we simply look at the total amount of financing raised. And we just got off a webinar with the UK and a global panel discussing what non-dilutive capital, whether that's considered part of the total amount of financing raised. And in my opinion, no, the non-dilutive capital isn't money raised.
Hmm. Okay. Well, it certainly has to be repaid, and that is kind of the quid pro quo when you're looking at positives and negatives of using debt. And that is that our debt, even though it doesn't require you to give us a lot of equity, it is first money out. So it's even ahead of the preferred. It's senior. It's
Got to pay
secure.
back.
Yeah, you gotta pay it back. So,
Right.
but we're not gonna make 10, 5, 4, 3. We're not even gonna make 2 times our money. We're looking for mid-teens kinda return.
Right.
So it's just definitely cheaper in terms of the cost of capital.
Well, that's really where, I was reading on your LinkedIn and your website is your whole line is
Mhm.
that you want to extend the runway for companies. And that's really so
Yeah.
what have you been seen be the most effective? Like what is your home run case? And where have you also had companies come to you where you've passed because it wasn't a right fit for the venture debt?
Well, let me do the second one first, because that I can do that very quickly. So it's not typically rescue finance, and it's also in our case not for early stage companies. So
That's the 15-year-old company, someone who's shown that they can stay in business and that they're not going under in duress.
correct, yes, and maybe more importantly, or adjunct to what you just said, is that if something does go wrong, that there's a buyer or a marketplace and the company can be sold. Because that's the only way to really
Yes.
monetize this quote.
Right, so
enterprise
all the
value.
and you use the word warrants, which means that's some kind of version of equity, but all the warrants in the world with a multiplier of 0 is still 0,
Yeah,
so that's
yeah,
help.
those warrants will be completely out of the money if something goes wrong, and that's okay. And another big thing, as is, and you were kind of asking what we look for, is we just need a good company. We don't need Facebook, Twitter, Snap, Open App. We don't need any. We don't need that. Um, we just need, honestly, the company to pay us back. And if we can make a little on the warrants, that would be great. But if they pay us back, that's that's the deal, and we're more than happy with that. So when we're kind of in a market where following like a long period when VCs just could have as much money as they wanted. And so they told their portfolio companies, just grow as fast as you can because growth is the metric upon which will maximize enterprise value. And then following WeWork, which is many years ago now, but there was a move from growth at any cost to one about path to profitability and balancing capital efficiency with growth. So the board said the unlimited amount of money uh, market that we were in has changed, and now we want you to get profitable. So the boards, the first thing they did was cut sales and marketing because it's the easiest to spend to reduce, and that of course reduced sales growth, which made it more difficult to sell the company or raise capital. So now the boards have come back, or
Right, it's almost
recently.
full circle to a combination of everything slow and steady in more of a holistic way where there's growth and there's profitability, but it's not done at a pace that can't be sustained.
Yes, that's well said. And by the way, try to do that without any new money. So that's the environment that we're in today. So the companies are coming to us with a lower growth than they probably could have had if they stayed on the original path. But as I said before, we don't need a hockey stick in terms of growth. We just need to be able to match their realistic growth rate with the right amount of debt so that they can pay us back.
How'd you get into all of this? I mean, you're a good old Midwest boy, right? And
Yes, ma'am. Yep.
Morgan and I were looking Morgan looks like at that fondly because, well, first of all, she went
I'm
to
biased.
Wisconsin. Yeah,
Yeah,
Yeah.
she's biased.
my daughter went to Wisconsin. Some of my best memories with my daughter are in Madison. Did you
Yeah.
you went to Madison, right?
I
Yeah,
did, I
great
did, yeah,
place.
unbelievable. I mean, I'm the worst person to ask because I'm very, very biased, but I think that
You're the
Madison
best
is
person to ask. And
it is,
Morgan's grandparents, my parents met and married at the University of Michigan 65 years ago. So that Morgan
Awesome.
being the oldest grandchild, they were always whispering in her ear from literally the day she was born, "Go blue." But I think the best article I ever read was when a guy from the New York Times or the guy
Jason
from the
Gay.
Wall Street Journal wrote an
Yeah,
article saying, he's so sick of even asking where all the interns come from because everybody went to the University of Michigan. And he said, but he prefers the people from Wisconsin and the Badgers because they are the quintessential first round, last round, and round after that kind of people. And I thought that was so, having spent time at Randolph Stadium, I would say that is absolutely a true
Camp
statement.
Yeah,
Randall,
it's true.
Jody,
Camp Randall. Sorry.
Camp
Camp Randall,
Randall, yes.
there we go.
Yeah.
Yep.
Well,
So, following on Jody's question, being raised in the Midwest and then getting into venture debt, which is even more of a I would say even more niche than venture capital because venture capital is much more mainstream. But the venture debt piece, especially in the last couple of years, really has become so attractive because the market condition, I equate it to like a parking lot or a gridlock because it's just been really and also just the
Hmm.
way that AI is changing the way that companies are hiring. I mean, there were 2 articles that came out in the Wall Street Journal this week talking about how companies are not looking to increase headcount, but want to and need to increase revenue. And in that case, venture debt, from what you're saying, if this is a company who's been around and really has that enterprise value, could be a really good candidate to be looking at venture debt.
Oh, yes, 100%. I'm Can I get that for our website?
I was gonna
That
Yes.
say, Morgan, you're a perfect,
very well said, Morgan.
well
So,
said. Well, we'll
yes,
give you a clip from this podcast so
We
you can put that on your
yeah.
website.
yes.
But you consider yourself an entrepreneur or innovator? I mean, obviously, you're a family guy, you're close to your daughter or however many kids you have. So is
Mhm.
this all holistic for you? Are you close with your clients? And I mean, we share a PR guy, that's how we met you, so
Yep,
obviously, we
yep.
have things in common more than we know, but what's been your mantra of doing all of this?
Well, so that you asked a bunch of questions, but the one that hits closest to home is, Family Guy. So I think that I am both a family guy and an entrepreneur. I probably started a dozen companies in my life, and half of those are in the finance world, and half are in the wine world. And of course, they're not all successful, but enough of them are to continue to put food on the table. But yet I try to,
Food and
stay.
wine, actually.
Well, I never have to worry about running out of wine. That I
That's good.
promise you. If you ever come over to my house, that's one thing we will not run out of.
So basically, anytime there's a natural disaster and you need to make sure you're taken care of, you go right to David's house and go right down to that wine cellar and just take a little bottle opener
Yeah.
and you'll be in a straw.
Yeah.
Yeah. Just stay there. Well, hopefully it's not an earthquake. But so, anyways, that's the family part is really important to me, and I knew that I was going to work on Wall Street, and I went to the University of Minnesota, and the day I finished, didn't even go to graduation, just packed up my trailer and drove to New York City to work at Solomon Brothers, and I um, have been on funding and supporting entrepreneurs ever since. First in investment banking, and then in I guess asset management, and then as a VC for a long time, and was really fortunate to have had some good success there and get on the Forbes Midas list, and that gave me the perspective to see this new tidal wave of of debt, in a good way, coming, and to be able to ride that wave.
What do you see next? I mean, you've obviously had perspective, you've been ambitious, you've had optics on this, and so far, even though despite some missteps, which is part of the deal, right? That's sort of part of the joy of the
Yeah,
journey.
that's how you learn. Yep.
Yeah, exactly. What's next in terms of this business? How are you seeing things today and moving forward? Everyone's
So
asking this, but it's, really
yeah,
great someone like you who has a long game on it.
so it's obviously speculative, but I see the importance of IPOs really diminishing, really diminishing. I mean, the entrepreneurs that I talked to in Silicon Valley, where 20 years ago an IPO would have been the holy grail, and your career wasn't complete unless you did an IPO. Today they don't care. They're just there to build a big and successful and impactful company, and whether they get the money in the private market or the public market, it doesn't matter. And the appetite for participating in the innovation economy by institutional and retail investors can be accommodated in other ways. You probably followed the secondary market. It's huge and liquid. So if any one of us felt like, oh boy, I miss the days where could invest in IPOs. Well, we can go invest in those same companies through the secondary market, and the amount of capital that's going into the best companies, the ones that would be going public, is crazy. Who I
Right, they're
saw
staying private for so
so
long.
long. Yeah, like Caruso, $1.4 billion round. I mean, that's obviously an IPO level kind of financing,
Yeah, but they don't
and
have to go because of the secondaries, and they don't have to go to the public markets because really that's a fundraising vehicle.
it is, and and it's never been a immediate path to liquidity because the only people that can sell are the ones that aren't really close. So if you're on the board, certainly if you're a member of management team, you're not selling your stock on the IPO. It's years before
Gotta
you can
hold.
sell.
Yeah.
Yeah. So
Interesting.
anyways, that's one thing I see.
And that's coming from somebody, and I think I read on your bio that you've been through 18 IPOs. 18.
Yeah, I think I've sat on the board of 18 companies that went public. So yeah, and Uh, sometimes we were able to sell and sometimes we weren't. So I've seen the good and the bad of that illiquidity event. So that's one thing. Um,
What
the,
would you
the,
say that an entrepreneur today might be a good way to wind up? Someone who's struggling, someone who is not, thought they were going to raise venture money. It's not so easy, but they know that they
yeah,
are the talent. They know that people are going to invest in them. So, how would you recommend that they approach the financing? A mix of and they don't have the 15 years. Is debt going to be
right.
available to them, or they shouldn't be thinking
Well,
about that?
so I guess my advice to an entrepreneur in that situation, and maybe I'll paraphrase to make sure I get it right, but you're saying they're successful, they've got a pedigree of success, and there are people that want to invest in them. I would advise in the early stages to try to avoid debt and be mostly equity, and most importantly, find the best partners, the people that are there not to satisfy their own ego, but are there to help build an important business and can add value. And that's the foundation that you need to build a business. And then once that foundation is stronger and you've created, I don't know, let's say something that's generating 20 million of revenue, then it's time to look at
To extend your runway.
yeah, to extend your runway, balance out your capitalization, and maintain more equity. There's another really important element that we haven't talked about, and that's control. Every time you give up equity, you're also giving up a little bit of control. And as you know, most of the times when there's a new round, there's a new board seat. And so, you've
More
got another.
complications and another cook in your kitchen.
You got it. And where that can be problematic is when it comes time to sell. And the VCs may want to sell before you do, or the VCs, and this is very common, where the VCs don't want to sell when you do because they want to hold on for a bigger number because their carried interest is based on that. And their calculation is if we hold this for another year and double the value, we get 20%.
Yeah.
So we don't want to sell yet. But maybe the management team feels like it's really the time. And then, of course, you as the entrepreneur have a very passionate perspective on the vision of the company.
Yeah, well, that's
And
where you're saying it's really important that your investors are aligned. And still, I think today, not to be forgotten, is that as an entrepreneur, despite the fact that money is harder to raise, if you are at the top tier and you're very passionate, we know that good teams are always attractive, and you still have to make sure that your investors and therefore your board are people with whom you want to have that long-term relationship. Because
yes,
this it's very tight community, as you said, and, people see each other on the way up and on the way down and on the way around, so
yes,
it's important to make sure that you fill your board seats and your bench with the right mix. Well, David,
you
I
can.
wanna thank you for joining us. You have so much knowledge from many aspects of this, and we can see why the ecosystem is lucky to have you, and we're lucky to have had you join us today, and we will look forward to doing business together in the future.
Absolutely. And thank you guys for your wise comments as well. Both of you had things that we can just put right on our website.
Take it. They're all yours.
Yeah,
Going to. Perfect.